Right, okay folks, welcome, thank you very much for your patience while we just sorted out a few technical issues. This presentation is going to focus on something slightly different to what we normally talk about. Normally I tend to focus heavily on price action, which to be fair, today's not really going to be too much difference. And normally I focus primarily on breakouts. Breakouts typically of the overnight or Asian session range. It's overnight for me. I'm obviously based in the UK, so if I do say the overnight range now or in the future, I'm usually referring to the Asian session range just because I'm based in the UK. So, if we're looking for breakouts, what if breakouts don't develop? What if there is no Asian session range? What if, like the last several weeks, we're seeing an average days move up, an average days move down, and an average days move up again? You know, price is technically ranging, but we're seeing some quite serious trending price action. And on some days, we're seeing 2, 3, and even up to 4 times an average day's move. Now, that obviously means, from an Asian session range point of view, the trade's just not available. The trade is just not available. So how can we trade those breakout pullbacks? How can we find trading opportunities by using some of the other tools that I look at? And one of the other tools that I look at is Fibs. Fibonacci, again, I'm not going to bore you with the history of Fibs. If you want to read that, there's plenty of places on the website for it. So from a practical point of view, how can we utilize the Fibonacci retracement tool to identify trading opportunities? Well, first of all, let's just go through some of the basics. First of all, with everything I do with trading, I want to keep it simple and I want to keep it rule defined. This for me means there's going to be no judgments. No, well, if I just did this or just did that. I want to know precisely what I'm going to do, when I'm going to do it, and why I'm going to do it. That is, at every stage of the game, that's ideally the decision I want to make. So I want to keep it simple. Now, to find the starting and end points from my Fibonacci retracements, I'm going to use the same price action definition for a swing high and a swing low. I'm going to look for a thrust move. Now all that is trending price action. So I need to see trending price action. For me, Fibs is a trending tool. I'm not going to use it when price is ranging. I typically look for a trending movement. That's what I mean by a thrust move. So basically, take your Fib retracement tool. Again, software works all this out for you, so there's not a great deal of calculator action involved. You take the Fibs from the start of the move to the end of the move, so swing highs to swing lows, or swing lows to swing highs. The 3 main ones that I follow are the 38%, 50 and 61% Fib retracement levels. There are other ones, obviously. There are many other Fib levels. But at some point, you've got to just say to yourself, all right, well, I'm not going to use certain ones because I might just end up picking random points on the chart if I was to use every conceivable Fibonacci retracement level. So, quickly, what is a swing high, what is a swing low? Just to remind people, a swing high is a bar preceded and succeeded by lower bar highs, 3-bar combination. A swing low is a bar preceded and succeeded by higher lows, also 3-bar combinations. So we can use swing highs and swing lows on the charts. And other considerations that I do like to use are to use extreme highs and extreme lows, which basically is the current day's highs, current day's lows, previous day's highs, previous day's lows, previous week's highs, previous week's lows. And the swing high-low definition on different time frames will usually capture those key turning points. That's what I'm looking for, key turning points. I'm not too concerned personally with the intraday fluctuations, the swing highs and swing lows that are in basically the middle of the current day's price action, for example. I'm looking for the extreme movement. So typically my starting points are the current day's highs and the current day's lows. That's my usual consideration. Now, you also need to keep in mind that my personal trading objective for intraday trading is to capture the main move of the day. So that's why I personally am looking at the current day's highs and the current day's lows to try and aid that objective to capture the main move of the day. There's nothing wrong with using these on lower time frames and using it as a scalping strategy, and we'll look at that later on and how we can adapt that for different people's objectives. But again, keep in mind when we're talking about the Fibonacci retracement, my personal objective is to capture the main move of the day. So swing highs and swing lows, again, just a quick visual illustration. Swing highs, swing lows, red arrows, swing highs. They're all bars preceded and succeeded by lower bar highs. And the blue arrows, they're all bars preceded and succeeded by higher bar lows. Very quickly, is everyone happy with the, just literally a bare bones outline of Fibonacci retracements and how I like to use them? Just go back to the relevant slide. Is everyone happy with that so far before we move on? This is obviously just an introduction for the moment, and then we'll move on to the strategy side of things in shortly. So any questions so far? So Fibonacci extensions then. Again, I want to keep it simple. A Fibonacci extension is a percentage extension taken from a percentage retracement. So if I'm using the same retracements or the same swing highs and swing lows for retracements, I can use the same definition to work out extensions. Again, I'm looking for a thrust move, the start of the move to the end of the move, but the calculation, that distance, again, we'll look at some examples, that distance is going to be added to the start of the next move down. Typically, I'm interested in a 100% extension, although, as with retracements, there's many other retracement levels. So just a quick, that should be a video, but we'll come on to the chart in a moment. So let's just see what those look like for the moment. Just going to stop the slides and we'll jump to the charts. Right, okay, we should be all seeing a full screen chart for the moment. So with retracements, these solid red lines, these represent the current day's highs and lows for the respective price action. So using the Fibonacci retracement tool, I'm looking, as I said before, I'm looking for the main move of the day. The main move, my objective is to capture the main move of the day. So with that in mind, I'm just going to take the high of Monday to the low of Monday. Again, we'll look at some more specifics in a moment. But the high of Monday to the low of Monday. That gives me some retracement levels, 38, 50 and 61% retracement levels, these three middle lines here. So in prices at these levels, these are levels that I'm going to be interested in to take or initiate a potential trade. Now the direction is down for Monday's price activity, as we can see there. So I'll be looking for price to retrace for a shorting opportunity. Now, just while we're on the subject of Fib placements, the next consideration for me, if price went above the 61% retracement, as it did, just poked its head above that 61% retracement yesterday, the next consideration for my Fib placements is none of these, there's a few lower highs that we could use from last Friday's price activity. Now, I'm not interested in those. I'm looking at the turning points. So the next consideration for me would be to take the Fibs back to the previous day's high, which in this case would be Friday's high, and that would be the next consideration for me. And so on, I'd take it back to Thursday's high, Wednesday's high, and so on and so on. I'm not interested in the intraday fluctuations because my main objective, as I just keep saying, is to look for the main move of the day. So just as a quick example, I'm not interested in placing my Fibs from the middle of price activity, although we can see a reaction here. I'm not interested in placing my Fibs with these locations. So that will basically be the middle of the day to the low of the day. I'm not interested in that. I'm using current day's highs, current day's lows, previous day's highs, previous day's lows. So just an illustration, let's leave start of Friday down to Monday's low. Let's think about the Fibonacci extension. I'm using the same location. So, okay, we've got price at an interesting level at that 50% retracement with the Fibs taken from Friday's high down to Monday's low. So the Fib extension, same tool, same locations. So if we've used those locations for the Fib retracement, I'm going to use the same locations to calculate the distance of that thrust move. So what the Fib tool does is it measures the distance from the start of the move to the end of the move. Now what I'm going to do is then take that up to the start of the next move down. Now, we don't know, just scroll back in time. In real time, we don't know that that's going to be the start of the move until it's done. But what we do know is that if we were looking at this in real time at the time, that if price gets up to that level, that's the highest point here that price is retraced to. That's the highest point at this point of the chart that price retraced to. So the height of the pattern, which is the start of the move to the end of the move, where we took the original retracement levels from, using the Fib extension tool now, I'm going to take my Fib extension tool and measure that distance and add that distance. Again, the software on TradeStation does it for me. So I'm going to add that distance to the start of the next move down. That's the level, the location that you're taking a trade on. So start the move to the end of the move, added to the start of the next move down. Again, software does it all for you. Let's just go back to the live part of the chart. That gives me an extension location. 100% extension is what I've got marked up. So the height of the pattern added to the start of the next move down gives me 100% extension, which is 129.30. That's potentially where a measured move using fibs is a projected target level. So that's the retracements, that's the extensions. Any questions so far? Right, okay, let's think about putting this together in a strategy. Right, so we should be looking at Trading with Fibs Part 2. This is the strategy side of things. We'll look at the theory, and then we'll look at putting that into action, or how we could put that into action. So, Trading with Fibs Part 2, this is the strategy side of things. This is how I put these things together. So, again, looking to trade a Fibonacci retracement. So, we've looked at taking the starts and end points. So, when price gets up to that level, I'm looking for the 50 or the 61% retracements. I'm not looking to take a trade on at the 38%, and I'll explain the reasons why in a moment. So I'm looking for, if I've identified a thrust move, a trending move, I'm then looking for price to retrace to at least the 50%, and ideally the 61%, because that gives me more profit potential, but at least the 50% retracement level. So that will be when I become interested in looking at the trading opportunity. As it says on the slide, this is pretty much the same as trading a pullback. If we were looking at, say, a range breakout pullback, for example, it's pretty much the same as trading a pullback, and you can use this method with a range breakout or a range breakout and use fibs to refine the entry method. So it is still a pullback, but what we're doing is instead of taking the breakout to a new low with the pullback, we're using the fibs to refine the entry and hopefully get a more advantageous entry. For me, stops always go past the events that cause me to get in the trade. Again, we'll look at that in a moment. A target can be a measured move, as we've just illustrated. For intraday trades, I tend to focus more on an average day's move than a measured move, although there's nothing wrong with using either or either. For intraday trades, personally, I look for an average day's move. And at the moment, average day's moves are out the window, if we're going to be honest with ourselves, because of the current volatile situation that's going on in the economic climate. But for other time frames or other slightly tweaked applications of this, we can use a measured move. There's nothing wrong with that. Intraday trades, I tend to look for an average day's move and a measured move. If I'm looking at this pattern on, say, a 60 or a 240-minute chart, I'll tend to use a measured move. And that's it, folks. So that is really the rule. So how do we actually use that for a trading opportunity? So let's look at some examples. And back to the charts. Can we all see the four charts? 4 charts, great. Thanks very much. Right, okay, so how do we then put those into a strategy? Let's think about some rules. If I'm looking for a move up to at least a 50% retracement, now using the 15-minute chart, we can refine this, the entry as well using different time frames, and we'll look at that again in a moment. But let's think about how we can actually take a trade on with the fib. So again, let's look at the euro-yen trade that's already developed. So start the move down to the end of the move. We've already previously identified that. So price needs to get up to at least the 50% retracement level. Just a quick question, actually. For these type of markets at the moment, Fibonacci is a better way of trading. It's not necessarily a better way of trading. It certainly is providing trading opportunities, because with the way that I trade, I'm I'm looking to capture an average day's move. Now, what we're seeing, again, if you just look at the charts, you know, if we look at, so if I just mark off the 6 o'clock times, and these are the times of the day that I'm starting to look at the chart. I'm based in the UK, which is, at the moment, GMT +1 is UK hours. So these vertical lines, these represent the times on the chart. About to be fair, about 7 o'clock is when I'm looking at the times. That's typically when I'm coming to the desk. So these vertical lines represent when I'm typically at the desk, starting to look for trading opportunities between 7 and 8 o'clock UK hours, which is GMT +1. So the vertical lines, what we can see is prior to those vertical lines in the overnight or Asian session, we can see we've got some quite heavy trading activity that's already developed. That is, price has already started to trend. So for me, one of the rules that I use quite often is if an average day's move has already been done, then I'm looking for a fib retracement setup, because there's no breakout trade. What I expect the day to do has already been done. But what we're seeing at the moment, given the current economic conditions, is we're seeing 2 and 3 times an average day's move on a regular basis. And some days, even 3 and 4 times an average day's move on things like the pound yen. It really is quite unusual price activity, but then it's an unusual time to be trading. So prior to these vertical lines, again, we can see an average day's move is done. Typically, I'm looking for a fib retracement setup. There's lots of average day's moves are done, which is reducing my breakout trading opportunities. But it doesn't mean that there's no trading opportunities. As we're looking at fib retracement setups. And I think at the moment, certainly looking at the stats that I've done, pretty much the only trades I'm doing at the moment are fib setups. So start the move to the end of the move. Let's think about a rule for this. Typically for intraday trading, I'm looking for price to get up to at least the 50% retracement level. So what we've got here is a move up to the 50% fib. And then I'm looking for a bar to close below the lower value fib. So I move up to the 50 and a close below the 38, or a move up to the 61 and a close below the 50. Now for intraday trading, looking for a single day trade, this offers up, the risk that's involved is usually quite low. Now what we can see, given the current volatile conditions, let's just mark off the high. So my stop loss would go past the event. Let's just zoom in actually. So I'm looking for a movement up to the 50% fib, which we've got. I'm then looking for a bar to close below the 38% fib. The bar that closes below the 38% fib is the trigger bar for the entry. So this is the trigger bar for the entry, with an entry below the trigger bar. The stop loss would typically go past the event that caused me to get in the trade. Now the event is basically the highest point of the retracement for me, the highest point of the retracement. So I move up to the 50 and I'm looking for a bar to close below the 38% fib. So I move up to 50, close below 38. Everyone happy with the entry on that? So I move up to the 50 and I'm looking for a bar to close below the 38. The bar that closes below the 38% fib retracement is the trigger bar for the entry only. The stop loss goes past the event where the red arrow is. And is everyone happy? That's basically that's it, folks. That's the entry. Now, in this case, what we can see on the 15-minute charts, risk is quite wide. So from an intraday trade perspective, the risk might not be that attractive, but the potential rewards we know is quite significantly. Let's just go back to the fib extension. So the fib extension, fibs from the start of the move, same locations for the fib retracement, start of the move to the end of the move, added that to the start of the next move down. So the potential is all the way down at 129.30. So I'm taking about 100 point. So you would be taking about 100-point risk on this trade, but you're looking ultimately for a 1,000-point reward. Yeah, Bones, it is far from the entry. This is one of the things that we're going to look at. We're going to look at refining this a little bit further. So from an intraday trade perspective, if risk point of view, it's not too attractive, but the risk reward on the trade is very attractive. From my perspective, it wouldn't be something I would take because, as you quite rightly identified, the stop loss is quite large. It is quite large. So how could we refine that trading opportunity? How could we refine that? Any guesses while I'm just setting up the chart? It is based on price action. Yeah, tick chart entry. Personally, with TradeStation provides good tick charts. I do quite like them. If you don't have a tick chart, a 2 or a 3 minute chart will give you a similar effect. Right, so we've got the location on the chart. We've got the 15-minute entry. So the 15-minute entry. So identify the level. So with the Fib retracement, identify the thrust move. I'm looking for at least a 50% retrace. Then I'm looking for a bar on the 15-minute chart to close below the 38% Fib retracement level. The bar that closes below the 38% Fib or the lower value Fib, because it could be a 60 or a 50 combination for the Fib setup, but the lower value Fib, the bar that closes below the lower value Fib is the trigger bar for the entry on the 15-minute chart. So how can we refine this? All right, we've got quite a large risk on the 15-minute chart. Now, before that's actually developed, one of the things that we can look at is refining that on the lower time frames, with price action. Again, this is something that we've harped on about for many, many weeks in the past. So what's price doing? Let's just go back in time. What is price doing? So we're now thinking about the price action sequence. The price action sequence, if you're not familiar with this or you're not too familiar with this, so if you're not too familiar with the price action sequence, you can read the article there. There's also a short video on it. So the price action sequence, when price is trending up, it's making higher highs, higher lows. When price is going down, it's making lower highs, lower lows. When price is range bound, it's neither making a new high on the move or a new low on the move. Price is range bound. 3 ways that the market can go: sideways, up trending, down trending. So on the way up to, we know that, if we just go back to the 15-minute chart, we know that when price got up to that 50% level, it was at that 4100 zone. Yeah, on 15-minute charts. So back on the tick chart, price on its way up to that level, up to that 50% retracement level, price is making higher highs, higher lows. We know that the overall trend is down. Looking at the 240-minute chart, that was what helped us identify the thrust move in the first place. Price was trending down. I'm looking to sell a rally in a downtrend at that point of the charts. What's price doing? So on the lower time frames on the tick chart, if you don't have a tick chart, a 2 or a 3 minute chart will do you just as well. What's price doing? At this point, it's going up. So what I'm looking for is for price on the lower time frames to tell me that it's going down. It will start going down when price starts making lower highs, lower lows. So we've got high, higher, low, high, higher high, higher low, higher high, higher low, higher high, higher low, last red arrow, lower high, bar preceded succeeded by lower highs. Price is making a lower swing low, high, higher low, lower high, lower low. That's your 1, 2, 3 pullback, 1, 2, 3 Ross hook, multi-point reversal, 1, 2, 3, 4, 5, trading the first pullback after the failure to make a new high. This pattern's got many different names, many different guises. It all amounts to the same thing. There's your bias change, folks. So we can refine the entry using price action on the lower time frames. Everyone happy with that? Everyone happy with that? So we can refine the entry based on the lower time frames. The whole purpose of the exercise is to find a location that is interesting. An interesting location is one that you are prepared to take a trade on board. If you're a trend trader, which is typically like me, you're looking to sell the rallies in a downtrend and buy the dips in an uptrend. So this, we know the trend is down. Looking at again, the 15-minute chart or the 240-minute chart, we know the trend is down. So we're looking for a trading opportunity by selling the rally in a downtrend. We've identified a level based on Fibonacci retracements that we're prepared to take a trade on board. We've got 2 options for an entry: a 15-minute chart entry, which at the moment sometimes is producing quite large risk, but we can refine those entries based on the lower time frames. Lower time frame, I typically refer to a lower time frame, basically a scalper's type entry. It's try and refine that to a low risk trading opportunity. Everyone happy with that so far? So this is the first point in time. We're looking for a bias change, that price is making lower highs, lower lows. To be fair, Bones, 100-point risk versus 1,000-point return. Risk reward is there, but appreciate the stop losses. Mark was talking about reducing your size in the previous presentation. So if you want to take this on in the current volatile markets, you're going to need to reduce your size. Think about it. If you're only risking 2% of your accounts, you could take 1,000-point stop loss size and it will still only be 2% of your accounts. Again, Mabel, work with the tools that you've got. If you haven't got a 2-3 minute chart, 5-minute chart should give you a similar effect. So at the moment, as Bones has again quite rightly said, some of these stop loss sizes are still quite big. So what you need to decide as an individual trader is what size stop loss are you prepared to take. Now you can do this one of two ways. You can either reduce your size to compensate for the larger risk that you're taking on the trade, or you can give you, I mean, to be fair, what I do is I give myself, because primarily I'm looking for intraday trading opportunities rather than, you know, swing trades. I mean, this example that we're going through, this would clearly be a swing trade. You'd be looking to hold this overnight, maybe for a few days. Realistically, so from a swing trade point of view, 100-point stop loss size, not that much. From a day trade point of view, intraday trade point of view, 100-point stop loss, quite big. So what I prefer to do is I've worked out my maximum stop loss size. I've worked out what 2% of my account is with what I'm prepared to take as my maximum stop loss size for day trades, for day trading. So that's what I've done personally. So from a day trade perspective, you're quite right, Bones, 100-point stop loss size, it's a little large for a day trade, but we know we're most likely going to have this 1,000-point potential rewards on this. From a swing trade point of view, it is a possibility. 100-point risk versus 1,000-point rewards. Do the math. It's a good risk-reward trade. But if that's still beyond your risk tolerance, let's look at some other options. How can we adjust the strategy and still stay within the confines of the rules to find a better trading opportunity? So before we go any further, is everyone happy with the basic rules? You can play around with this as much as you want, folks. And again, as Bones is quite hard, and we're actually skipping ahead by answering that question. But is everyone happy with the basic strategy? Identify a thrust move. Thrust move is trending price action. And you're looking for at least a 50% retracement. Now, from a day trade point of view, I'm looking to capture the main move of the day. So, which is why I'm looking for a 50% retracement. Because if my normal under normal market conditions, appreciate it's not normal at the moment, folks, given the current climate. But under normal market conditions, whatever that is at the moment, I'm looking to capture an average day's move. So if an average day's move is done, I'm looking for price to retrace at least 50 to 60% of an average day's move, or what it's done for today already. And that will give me back my profit potential, because my profit potential is based on an average day's move. If an average day's move is done, again, typically, just look back, we did this, we didn't present last week, the week before. We went back through the charts and just looked at an average day's move. Typically, when an average day's move is done, price stops. So if an average day's move has been done, my expectation becomes quite low, which is why I'd be looking for a fib retracement setup. So we've looked at a swing example. Let's think about a day trade example. So we'll look at Euro yen for today. We've looked at the 15-minute entry, which is basically a move up to the 50% or 61%, and a close below the lower value fib. So a move up to the 50 and a bar that closes below the 38, or a move up to the 60 and a close below the 50. That's what we're looking for on the 15-minute chart. We can refine that entry with the lower time frames, 8-9-tick charts, 2-3-minute charts, or even a 5-minute chart. You can refine the entry based on the price action sequence and look for lower high, lower low sequence. That will be the first point in time the price is telling you it's going the other way. Again, within the overall scheme of things, price is trending down. prices retrace, sell the rally in a downtrend, and that's what we're looking for. So let's think about a day trade. So we've looked at a quasi-swing trade, right? So we looked at a swing trade. So let's think about a day trade. For day trading, what can we be looking for? We've actually already had some set up today, but again, the risk was outside the tolerance for a day trade. Excuse me. So thinking about today's trade, today's price activity, first of all, fibs from the high of the day down to the low of the day. Right, we've got the thrust move, swing high, swing low, current day's high, current day's low. I'm looking for price to get up to that 50% retracement. So we're looking at a real-time trade now, waiting for price to get up to that 50% retracement. When it gets there, what I'm looking for are movements up to the 50%, a close below the 38%, or a move up to the 61% and a bar to close below the 50. The bar that closes below the 50 or the lower value fib is the trigger bar for the entry. Stop losses, as mentioned, go past the events, which would be the highest point of the retracement on the 15-minute charts. Now, what we can do, as we've basically just discussed, is we can refine that entry based on price action. So price action, as we can see, it isn't up to that 50% retracement. We're looking for 136.40. The high of the current bar is 136.16. So we're looking for price to get up to that 50% retracement level. It's not always going to, always keep in mind, folks, it's not always going to touch the 50%. I use about a 4 or 5 point tolerance. If it just falls short of the 50% retracements by, say, 4 or 5 points, I'll consider that a touch. If it goes through it, not an issue. But if it just falls short, about 4 or 5 points, I wouldn't go any further than that personally. Otherwise, again, you're just picking random points on the chart. So looking for a movement up to the 50, close below the 30, 15-minute entry, bias change entry. What are we looking at? Well, first of all, let's just mark a few of the swing highs, swing lows. Price is making, again, just going back in the sequence, just counting backwards. What can we see? When we put the arrows on the chart, it becomes clear. What's price doing? On this retracement, up on the 50, so selling the rallies in a downtrend. On this retracement up on the lower time frames, price is making higher highs, higher lows. And it's looking like that's going to be another higher low. So what I'd be looking for, first of all, price to get to that 50% retracement level. Then I'm looking for a close below the 38 on the 50 on the 15-minute chart, or a bias change on the lower time frames, which hasn't. The first condition hasn't been met. We've got the thrust move. We've identified a level that we want to take a trade on board, 50% retracement. Ideally the 61, because that gives me greater profit potential. As it stands at the moment, we've seen an average day's move down, an average day's move up, or more than an average day's move, and more than an average day's move down. So 80 odd down once, twice, 3 times. It's still not provided a low risk entry opportunity for me. For intraday trades, it's not quite there yet. So price has got to come up to the 50. We can refine the entry with price action on the lower time frames, or we can take a 15-minute chart entry if the risk is right. As Bones mentioned earlier, sometimes the risk is going to be not acceptable. Because if you're taking 100, I mean, to be fair, on the pound yen, it's nearly a 200-point risk this morning with a similar setup. And the average day's moves had already been done. You know, we're coming up to, based on a 100-period average true range on a daily chart. That's what I focus on for an average day's move. At the moment, the last several days, it's doing about 470 to 500 points on average over the 14 periods. Now, I like to use a smooth 100-period daily average true range for what it does on average, because that is, on the long term, what it does on average. So we're seeing some average days move in excess of that 100 daily average true range, which for me is reducing my trading opportunities, but at the same time, it's also keeping me out the market on some of these very, very volatile moves. Again, you can see an average day's move down. It'd be 300-400 points in profit. It's not hit your profit target yet, and then you see it do 400 points up, which is what we were looking at this morning. And then it's done another 400-500 points down already. You know, very, very volatile conditions at the moment. I think best advice is it's better to be out the market wishing you were in than in the market wishing you were out. So if you're on the sidelines and the risk isn't right and the trade's not quite setting up, don't worry about it. It's a good time to learn discipline, to learn patience, and wait for the better setups. So we're looking at euro yen, move up to the 50, close below the 38, or a bias change. Let's just take a look at the euro. Any questions so far before we look at something slightly different and but along the same lines? Mabel, there's two possible entries. For me, it's whichever comes first. It's either a 15-minute entry or it's a bias change entry, whichever develops first. So I move up to the 50%, for example, and I close below the 38%. The bar that closes below the 38% fib, or the lower value fib, is the trigger bar for the entry. So you look at, in the examples we've been looking at, you'd be looking to go short below the trigger bar, below the low of the trigger bar. Or you can go to the even lower time frames to refine the entry. To be fair, as I'm just saying, on 50 minutes, I'm not cross-checking. It's whichever setup comes first, because sometimes the 15-minute will develop before the bias change. Sometimes the bias change will develop before the 15-minute entry. For me, it's whichever comes first. Just want to check the charts. Can we still all see 4 charts? Let's just check the recording. Okay, brilliant. Right, let's restart. Okay, so we've looked at fibs. We've looked at how I use fibs. Personally, I like to keep it simple. There's lots of swing highs and swing lows on the chart and the time frame that we can look at. Many locations that we could use it as start and end points. For intraday trading, what I like to use is the current day's highs, current day's lows, previous day's highs, previous day's lows. And for the entries for intraday trades, I'll look at using 15-minute entry or a bias change entry on the 89-tick chart. So for day trading, 15-minute entry on a fib or a bias change entry on the 89-tick chart. If you don't have an 89-tick chart, a 2 or 3 minute chart will do. But if you don't have those, again, just work with the tools that you have, 1 minute or a 5-minute chart. For those of you who use MetaTrader, there are some plugins that allow you to have some flexibility with different time frames as well. Right, so let's think about euro-dollar. So euro-dollar, slightly different situation today. It looks like it's trending. Could it be ranging? Let's just think about the range breakout for a moment, because what we had this morning was we had an overnight range, price swing high, swing low. Let me just mark that off. And price was making lower highs and higher lows within the previous swing high and the previous swing low. I think it'd be fair to say, just to adjust that swing highs we did in my trading this morning, we've got the majority of the price action being contained first thing this morning between those levels. Now on the 60-minute chart, what I like to do is look for a range in the 60-minute chart. So looking for an overnight trading range to look for a breakout trade opportunity. Ideally, the range needs to be at the high, basically in the top third or the bottom third of the previous day's high-low range. Okay, can you see a full screen, folks? Is it full screen, 4 charts, or just 1 chart? 4 charts, okay, brilliant. Right, so we've got a 60-minute chart. Okay, what I was looking at, we've got the overnight trading range this morning on euro-dollar. So again, just thinking about the range, thinking about the plan for the day. So now we're looking at basically just flipping back in time and saying, well, we've got an overnight trading range, but where's the location of that range? It's in the middle third of the previous day's high range. The previous day's highs are these solid red lines. So I can see that the overnight or Asian session range, or the majority of the price action, is in the middle third of the previous day's high range. The Asian session range or the overnight range that I identify needs to be at the top third or the bottom third of the previous day's high range. So thinking about a plan for the day for the euro, the location of this range-bound price activity, it's not in the best location. Typically, when price is range-bound in the middle third of the previous day's high range, again, people who have attended the sessions will know that if price is range-bound in the middle third of the previous day's high range, it usually leads to an extended consolidation. Again, usually is the key word there. And usually what it will develop is an asymmetrical triangle. What have we got today so far, folks? Price is squeezing, asymmetrical triangle. That's what we're saying when price is in the middle third of the previous day's high-low range. So what I'd be looking for, as I've said several times in the past, I'd be looking for If price is in the middle third of the previous day's high-low range, price is typically going to be in an extended range. I'd be looking for a break of the previous day's high or a break of the previous day's low. They're going to be my long and short triggers. Now, if price does that, I'll have to consider an average day's move. Because if it gets down to the low, if it gets up to the high and breaks those levels, you know, there's 250, 260 point difference between those levels. So if price was to break through the high, break through the low, I'm not going to take a breakout pullback. I'm going to use fibs. Because average day's move has been done, the potential for the day has already been done. So if it does break out, either through the high or through the low, ideally, I want some profit potential to come back in my favor. So on Euro, I'm looking not only for a breakout and a pullback, but a pullback to a fib retracement level, that 50% or 61% retracement level. I don't know which way it's going to go. At the moment, prices show me an extended consolidation. I'm looking for a break of the high of yesterday, break of the low of yesterday, and then looking for a fib retracement setup. Does that make sense? So just showing you the flip side of it. If you don't have the range breakout or the range isn't in the best location, it's not the end of the world. There can still be trading opportunities. We can use fibs to identify those. So we've looked at finding trending price action. We've looked at when price is range bound and what we can look for and what we're waiting for if the range isn't quite right. And we can identify the trading opportunities and think about the plan ahead for the day. Range, overnight range, not the best location. Looking for the previous day's high, previous day's low to be broken. If it does happen, I'm not going to take a breakout pullback because the day will be done as far as I'm concerned based on an average day's move. So I'm looking for a fib setup. Does that make sense? Everyone happy with that? Right, let's think about so any question, right? That's the basic strategy. That's how I use it, folks. That is ultimately what I'm looking for. In the last couple of minutes, let's just think about how we can adapt this. So clearly we've looked at a swing trade, we've looked at an intraday trade that's still pending, and we can look at that, or you can look at that at your own time later in the day. Let's just think about using this for a scalping strategy. I'm on the 89, I'll use a 2-minute chart because most people don't have tick charts. Let's put a 2-minute chart on. So most people don't have tick charts. I've just got a 2-minute chart on now. So you've identified that you might want to sell. Selling in a downtrend, so you're looking for short trading opportunities. So very quickly, let's just put some price action sequence on here. Price is going up. You're looking for a short trading opportunity. You've got a bias change here. High, high, low, lower, high, lower, low. The risk for a day trade is phenomenal. Risk for a day trade is phenomenal. In excess of 100 points, right? From a day trade point of view, I don't want to take that trade because it's beyond my personal, the way I manage my accounts, the way I manage my trades, that's beyond my risk tolerance. And certainly from a day trade point of view, beyond my risk tolerance. What can we do about it? What can we do? Well, you can basically decide that, well, hold on, I'm not going to look for the intraday moves. I'm not going to look to capture the main move of the day. What you might want to do is take that hat off and go, right, I'm going to put the scalper's hat on. So if you're going to do that, you need to keep in mind that it's a different way of thinking. It's a different mindset. So what we can do on the 2-minute chart, exactly the same strategy. That bias change is triggered. If you look back on the charts, you will see that using yesterday's high and today's low, you'll see that this is at a retracement level, fib retracement level. The bias change is triggered. Fib from the start of the move to the end of the move. Move up to the 50, close below move up to the 61, close below the 38. Again, let me just put candles on so we can see this. That should be a little bit clearer for us. So we've got the bias change, that's triggered. Once that bias change is triggered, you could say, well, I'm going to look for a low risk trading opportunity, but I'm going to put the scalper's hat on. I'm going to look for quick trading opportunities. Start of the move to the end of the move. Same pattern, folks, exactly the same pattern. Start the move to the end of the move, move up to the 61, close below the 50, the bar that closes below the 50, trigger bar for the entry. There's your entry below 136.57, stop loss above 136.99. So still quite large from a scalping point of view, but nevertheless certainly better than providing a trading opportunity. Fib extension then, so fibs extension from the start of the move to the end of the move, add that distance to the start of the next move down. That's giving you your extension. So your target was 35.80. Obviously that's triggering now. Or sorry, that would have triggered. And again, now you're back to looking for another trading opportunity. So start of the move to the end of the move. Start of the move, a couple of options there. Move up to the 50, close below 30. Not quite an ideal situation as it goes into a consolidation. But nevertheless, move up to 50, close below 30, or close below 30 provides the entry. And we can be looking for an extension. Start of the move to the end of the move. Add that to the start of the next move down. Target 135.05. Two scalping entries. So again, adapting this from a scalper's viewpoint. Start of the move to the end of the move. Previous swing high, previous swing low. Move up to the 38. Doesn't get up to the 50. No trade. You're looking for trading opportunities. Fibs from the higher of the day down to the lower day. We've done this on the 15-minute chart. It's not quite at the 50, so from a 15-minute entry point of view, not quite there. The bias is now going back to the downside. So price making high highs, high lows. You're out the market here, waiting. Small consolidation. Price making high low and a lower high within the previous swing high and the previous swing low. Asymmetrical triangle if you want to put a label on it. You're looking for, now in real time, from the scalper's point of view, you've got the start of the move to the end of the move. Let's just zoom in. So you're looking for a retracement. We've not got the swing low, so we're just guessing at this just for illustration because of time. Start to move to the end of the move. You're looking for a retracement up to the 50 or the 61, close below the lower value fib. That's going to provide a short scalping opportunity based on exactly the same strategy using fibs. Any questions, folks? I think that wraps it up quite nicely. We've looked at day trading, we've looked at swing trading, we've looked at scalping using exactly the same strategy, folks. Move up to the 50 or the 61, close below the lower value fib, the bar that does that. I think on a scalp, if you're looking at a 2-minute chart, on a scalping, I would look for a touch. I wouldn't use a tolerance. I would look for exactly a touch. No touch, no trade. For scalping, it's a very precise science for scalping. There's no margin for error. Whereas on a 15-minute chart, you can be a little bit flexible, or to be fair, larger time frames. 62, 40-minute chart, you can be a bit flexible. So from a scalping viewpoint, no touch, no trade. Swing trade, holding overnight. Day trade, looking to hold just for the day. Scalp trade typically refers to looking for short, quick movements on 1, 2, and 3-minute charts. We've already looked at the bias change type of entry on the 89-tick chart, which is a scalping style entry, but using that scalper's entry into a larger movement. So just purely from looking for quick moves, quick hits, we can use the same strategy on a 2-minute chart, purely a 2-minute chart, and exactly the same strategy. You're looking for small movements, you're looking for those quick retracements. You're not looking for the main swings. You're basically looking for, each swing high, each swing low. And we've been through a few very quick examples, to be fair. Again, just for illustration, start the move to the end of the move. You're looking at previous swing highs, previous swing lows on a 2-minute chart, not necessarily the main moves, which for a day trade point of view, it's going to be the current day's high, the current day's low. For scalpers, you're literally just looking for previous swing highs, previous swing lows. So now you've got that move up to the, quite clear you've got that move through and up to, and again you've managed to avoid that losing trade. Wonder what's going on with this, folks. Wonder what's going on with this. So has that got up to beyond that 61%? So just for illustration, very quickly, to move beyond the 61%, next consideration for me would be yesterday's high for the start of the move, yesterday's high, today's low, move up to the 50 or the 61, and again you can identify those same trading levels. So when price gets there, you can basically jump down to the lower time frames for a bias change, or you can go onto the say 2-minute chart for most people and look for those trading opportunities. Right, I think I'm definitely out of time now, folks. I've pushed it as far as I can. Thank you very much for your time. If you've got any questions, comments, observations, please send me an email, or you can contact me on the blog. Price action sequence. Price action sequence is there, which is pretty much what everything I do is based around. And you can also use the contact page if you do have any questions. Thank you very much, admin. I have run over. I do apologise. But thank you very much for your time, folks. Thank you very much for listening, and ultimately thank you for FX Street for hosting this presentation, which is being recorded. So if you want to watch it again, please feel free to.